While much of Europe is treading water, grappling with economic stagnation, soaring public debt, and inflation that refuses to subside, Denmark is quietly defying the trend. Across the continent, headlines speak of recession threats, austerity measures, and strained public finances. But in Denmark, the economy is not just surviving, it's thriving. Growth is accelerating, inflation is under control, and the government is running budget surpluses that most countries can only dream of. According to the OECD, Denmark's economy grew by 3.7% in 2024, the second fastest among all advanced economies, just behind Costa Rica. Inflation at just 1.5%, far below the Eurozone average. Public debt is only 31% of GDP, less than half of the EU average, which hovers around 80%. Meanwhile, countries like Germany, France, and Italy are barely staying above zero growth, battling 3 to 5% inflation and running significant fiscal deficits. Even in the post-pandemic world where global supply chains broke down and energy prices spiked, Denmark's economy managed to remain surprisingly resilient. While other nations were tightening budgets and raising interest rates to choke off inflation, Denmark brought its inflation below 2% without sacrificing economic expansion. But this isn't a fluke or a lucky year. This is the result of long-term structural choices that Denmark has made. Choices that appear counterintuitive at first glance, but are the product of deliberate long-term design. For a country of just under 6 million people, Denmark punches far above its weight. Its GDP per capita is around $75,000, making it the third highest in the European Union after Luxembourg and Ireland. This is not a country rich in fossil fuels, nor a massive industrial powerhouse. What makes Denmark different is how it uses what it has, and how it builds economic resilience into its systems. One major factor is openness to global trade. Denmark's trade-to-GDP ratio is 128%, more than double the global average and one of the highest in the developed world. That means Denmark is tightly integrated into global markets, relying on exports for growth. But unlike many other countries, it has diversified its trade across multiple sectors: pharmaceuticals, renewable energy, machinery, and processed foods. At the same time, Denmark has some of the highest taxes in the world. According to the European Commission, its total tax burden is 44.1% of GDP, the third highest in the EU. The top marginal income tax rate is 55.9%, the highest in the OECD. To most outsiders, that sounds like a recipe for economic disaster. But in Denmark, these taxes are not a drag. They're an investment. They fund a world-class welfare state, free healthcare, free education, childcare, and generous unemployment benefits. In fact, if a Dane loses their job, they receive 75% of their previous income for up to 2 years, compared to just 40% on average across the OECD. Despite these high taxes and high social spending, Denmark continues to grow faster than most of its lower tax peers, because these taxes are used not just for handouts, but for economic stabilization and workforce development. A laid-off worker isn't left behind. They're retrained and redeployed. This minimizes long-term unemployment and keeps domestic demand steady even during downturns. And that's where Denmark's unique labor market model comes in. A model so effective that economists have given it a name: flexicurity. In Denmark, hiring and firing is relatively easy. Employers aren't bogged down by rigid contracts or legal hurdles. But that flexibility is balanced by state-provided security, job training, income support, and reintegration programs. This might sound like a dream, but it's real. And it's one of the reasons why Denmark's productivity is rising, its employment rate is well above the EU average, and its economy keeps expanding even in turbulent times. But as impressive as this system is, it only explains part of the story. This kind of societal resilience is mirrored in Denmark's corporate structure. Unlike many advanced economies dominated by publicly traded giants, only about 13 of Denmark's 25 largest companies are listed on the Copenhagen Stock Exchange. The rest are either family-owned, foundation-owned, or structured as cooperatives, which significantly reduces their exposure to short-term stock market volatility and speculative pressure. For example, Arla Foods, one of Europe's largest dairy companies, is a farmer-owned cooperative with over 8,900 Danish members. Its structure prioritizes long-term price stability for producers over maximizing shareholder returns. Lego, Denmark's most globally recognized brand, is privately held by the Christiansen family through the Lego Group and the Lego Foundation, which together control nearly 100% of ownership. This setup enables strategic patience even in downturns without facing the disruptive influence of activist investors or hostile takeovers. This ownership model has real macroeconomic implications. Family-owned and cooperative firms are typically more risk-averse during booms, accumulating capital buffers, and less likely to engage in mass layoffs during busts. According to a 2021 study by the Danish Ministry of Industry, these non-listed large firms also tend to reinvest a higher share of profits back into the domestic economy. In short, the very architecture of Danish capitalism is more shock-absorbent. These firms may experience margin compression during global recessions, but their survival is rarely in question. And their stability adds another layer of insulation to Denmark's economy. Another factor behind Denmark's current boom is Novo Nordisk. In 2023, the name Novo Nordisk became known not just in pharmaceutical circles, but in households and headlines across the world. The Danish company, already respected for its diabetes treatments, catapulted to global dominance with the massive success of two drugs, Ozempic and Wegovy, both initially developed for diabetes but now widely used for weight loss. These drugs have reshaped both the pharmaceutical industry and the global conversation around obesity. But their success has done more than fill prescriptions. It has boosted Denmark's economy to unprecedented heights. According to Bloomberg Economics, up to half of Denmark's recent GDP growth can be traced to the success of Novo Nordisk. The company now accounts for more than 15% of Denmark's total exports and has become Europe's second most valuable publicly traded firm, behind only LVMH. While it's not unusual for one large company to impact a small economy, this level of concentration has drawn comparisons to Finland's Nokia in the early 2000s. A company that once made up 4% of Finland's GDP, but whose collapse in the smartphone era sent economic shockwaves through the country. On the surface, it might seem like it, but dig deeper and the differences are clear. Denmark's economic boom is not solely dependent on Novo Nordisk. The company has indeed been a major tailwind, but it's part of a broader, more resilient structure. Take manufacturing, for example. While much of Europe has seen manufacturing decline as a share of GDP, Denmark has bucked the trend. One of the biggest reasons is energy policy. Thanks to decades of investment in wind energy, Denmark now produces a plurality of its electricity from wind power, one of the highest rates in the world. Although domestic energy bills for consumers are relatively high, due to taxation, industrial energy costs are among the lowest in Europe. This has been a critical advantage. While German manufacturers struggled under the weight of rising gas prices and supply shocks following the Ukraine war, Danish industry remained relatively insulated. Energy-intensive production didn't need to shut down or offshore. In fact, manufacturing's share of GDP has increased in recent years, defying regional trends. Even the central bank's interest rate policy has followed a unique trajectory. While the European Central Bank and the Bank of England were tightening aggressively, Denmark kept rates relatively aligned with domestic realities, which, combined with its fiscal surpluses, helped suppress inflation without wrecking consumer demand. While most advanced economies are running significant fiscal deficits in the wake of COVID, energy crises, and defense spending hikes, Denmark has done the opposite. From 2020 to 2024, Denmark has posted budget surplus for the 5 consecutive years. This consistent overperformance has driven Denmark's debt-to-GDP ratio down from 46% in 2020 to just 31% in 2024, one of the lowest in the European Union, with projections putting it at 29% by 2026. To compare, Germany's debt to GDP is about 64%, France is at 111%, Italy is pushing 140%, and the EU average is roughly 80% and rising. It gives Denmark fiscal room to maneuver in future crises without needing austerity or aggressive borrowing. It also builds investor confidence, keeps borrowing costs low, and allows the state to continue funding social programs without cuts. In short, Denmark has built an economic machine that's not just running, it's humming. As the rest of Europe struggles with stagflation, shrinking productivity, and rising populism, Denmark quietly offers a different path. It's not a perfect system, but it proves one thing beyond doubt. Small countries with smart policies can punch far above their weight, even in a fractured global economy.